traders from across the globe. Welcome to Short-Term Trading Live with Oscar's 703rd video, baby. It's the 703rd installment of Short-Term Trading Live with Oscar, where we teach you about market techniques, we teach you about indicators, we teach you about formations and how to apply them to market movement. Traders, this video is being filmed on Tuesday night for Trading Wednesday. That is March 9, 2011. What do we have on the board? Well, before I discuss the 11-day cycle with you, I must tell you that futures trading is risky and can cause substantial financial loss. If you do not have risk capital to lose, please turn off to YouTube. If you have risk capital to lose and you understand this game, stay tuned. Traders, what do we have? An 11-day cycle. You see what's written on my board? 11-day cycle. And we have a green OMNI because of that 11-day cycle. Now, what am I getting at? Traders, I found what I think is an 11-day cycle in the E-mini S&P, the transportation average, the NASDAQ, the whole group, the U.S. indices. I think what happens here is we consolidate for 11 days at a time or 10 days at a time, and on the 11th day we break out, and I have some pretty graphs that may illustrate that for you. Traders, the transportation average has given us buy signals. Another round of applause for that, baby. The Dow Jones Transportation Average, deemed the leader of U.S. indices, has offered some buy signals, bringing us into a buy the dip day on Wednesday in the S&P. The Dow Jones Transportation Average, traders, was the first one to get hit on the downside when crude started to go up, and you would expect that, right? Imagine, transportation average is the grouping of stocks that move things around this country and around the planet. They certainly need energy in order to move things. If you have coal, you have to move it. If you have corn, you have to move it. If you make widgets, you have to move them out to market. So the transportation stocks are certainly the ones that are going to feel the brunt of high-priced crude. And traders, let me talk about this high-priced crude very quickly. 2007 through 2008, crude oil skyrockets above 100, hits 110, 120, 125, eventually works its way to 145. And the U.S. stock market cracks, and it cracks hard. It cracks from the 1400s all the way down eventually to 666. However, in 2007, 2008, when crude oil was rallying over 100, the S&P was coming down, but you did not just have the crude oil happening. You also had a scenario like this. The derivatives market has broken, the back is broken, and they are melting. The real estate market across this whole country, the back is broken, and it is melting. You had that coupled with crude going through the roof, and that broke the back of the S&P, the stock market, the U.S. economy. What's different about this run we're having right now? You have the stock market moving higher, and you have crude moving higher, but that is it. There's no real estate debacle. There's no derivatives meltdown. So traders, what I am here to tell you is that this is what will happen with this crude rally. As crude rallies, traders go, oh my God, crude is rallying. It's going to be so expensive. I'm not going to be able to drive my car. And the S&P has a little jolt and it pulls down. Then as soon as we get used to trading crude at $1.04, $1.05, $1.06, and we get used to $3.95, $4.05 gallon gas at the pump, everyone goes, oh, okay, life's back to normal. Everyone back in the S&P. And that's what we are going to see. Why? Remember, what broke the back of the economy was the derivatives market meltdown and the real estate meltdown coupled with crude skyrocketing, right? That broke the U.S. stock market. We only have crude skyrocketing right now. I think our market can sustain the crude rally as long as crude doesn't explode. Why do I think that? First, there's been no disruption in crude oil at all whatsoever. The movement of crude has been moving since the freedom fever broke out in the Middle East. So it hasn't disrupted crude oil, which means everyone that wants to buy their crude is getting their crude on time. So the reason why we're at $104, $105 crude right now is because there's a 40-some-odd billion-dollar bet that crude goes higher. That bet is across commodity pools, commodity operators. We are talking about hedge funds. We're talking about ETFs. We're talking about oil companies. Combined all their long positions, they say, the stats tell us, there's a 40-some-odd billion dollar bet on the upside. Now, traders, understand this. Bernie Madoff a year ago lost $50 billion, and that didn't even make our markets sneeze. $50 billion. What's the big bet in crude? 40-some-odd billion. You know what? In the larger picture of the larger scheme, the larger picture of things, I don't think $50 billion bet on crude is enough to stop a $4 trillion backed by the Fed S&P market, right? There's a $4 trillion bet the S&P goes higher. There's a $40 billion bet the crude goes higher. I say the S&P wins this race this year. So again, I think the S&P can sustain crude moving higher as long as it doesn't move too far, too fast. More about crude tomorrow morning, traders. I will be on Bloomberg Live tomorrow morning. It's a telephone interview, but live it will be on Bloomberg at 10:30 a.m. OST, equivalent to EST. Be there at 10:30 tomorrow morning, and I'll be on the air for you guys to hopefully call in and ask questions. Traders, if you'd like to see any of the interviews that we've done on television lately, come to our site and simply click the TV interviews link, and you can see all the interviews stacked up on one webpage. All right, so, traders, I want to get you into some charts right now. The 11-day cycle, what does it mean? With no further ado, let's go look at some charts. Okay, traders, an 11-day cycle, what am I referring to? You are looking at the March E-mini S&P daily bar chart with some of our OMNI averages overlaid on top. Inside of this box is something quite interesting. The averages separate greatly right before we get to this area. They come together, you get 11 days exactly, actually you get 10 days, then the averages come together right here, and then on the 11th day you get a blowout run. That's what we've seen on this one. And now we have the very same situation. What am I showing you? Right here, look how far apart the averages are, just like they were here. Suddenly they come together for 10 straight days, and all of them start to touch on day 11, which is tomorrow, and then you get your blowout day. Let me blow this up for you now, traders. I'm going to show you the same chart, but blow up these two areas and see if I can give you a better picture of the 11-day cycle. Okay, traders, the very same chart, the March E-mini S&P. Now I have blown this up, I've zoomed in. Look right here at how far apart my averages are, right? 1, 2, 3, they're far apart. For no reason at all, they come running together, and here's where it gets interesting. They run together, and they do this, and then they put in this little bird wing up and down thing, and then they come together right there. This is, count them, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. On day 11, it blows out. So now I'm looking at that, and I'm looking at this one over here, and I see the exact same thing. Look at this. Averages are far apart. They start to rush together. We have this little teeny bird's wing looking thing right here, and then the averages start to converge. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and this would be day 11. If it happens, we should start the upside on Wednesday, tomorrow, completing our 11-day cycle. Again, look how far the averages are apart. They rush together. They just about take 11 days to come together. On the 11th day, they blow out. Here, they're far apart. They start to rush together. It takes about 10 days, and they're all just about touching now. On day 11, they should blow out. That is my 11-day cycle I noticed in the S&P. Traders, I spend my life looking for these cycles. When they jump out at me, I explore them, and I am telling you that's an 11-day cycle. Now let's see if there's any indicators to back our theory that day 11 should be a rally day. Let's go look. Okay, traders, now we are looking at the indicators. These are indicators of the leader Dow Jones Transportation Average on a daily bar chart. These indicators have been overlaid, and traders, what I'm showing you is a very bullish looking RSI, a very bullish looking CCI or Commodity Channel Index. Your RSI, by the way, is your relative strength index indicator. Then you have your MACD, moving average convergence divergence traders. One of the most powerful indicators of the oscillating type of indicators that you will find is the MACD. When the MACD puts in a little wiggle towards the upside, that little wiggle means a lot. Here we are, we have two little wiggles and we're getting ready to cross the two averages, the red and the blue. When that happens, it's an absolute buy signal. So the granddaddy giving us a buy signal, CCI giving us a buy signal, RSI giving us a buy signal. Basically, traders, just about every indicator that I overlaid on top of today's transportation average chart gave me a buy signal. I like what I see. I say we go for the 11-day cycle tomorrow in the S&P, and we'll see if we begin our rally back to new levels. So, traders, you've seen my charts. There is my technical argument for the green omni, baby, and you gotta love green omnis. Now, what am I going to say about the green omni? A stop is your best friend, and you better make sure you got stops in, because traders, if crude goes up 300-400 points tomorrow, your stop on the downside, the S&P is getting hit. Here's what I've noticed, something I mentioned to my traders here in Vegas in my office on Sunday night. I said, traders, starting Sunday night, this is the week where every tick up in crude is a tick down in the S&P, and every tick up in the S&P is a tick down in crude, and you will see them like opposite sisters every other tick this week. Started right out of the chute on Sunday evening that way, was the same way Monday, was the same way Tuesday. I think it's starting to wear off already. I think the attention span of us traders out there, oh, what? The Middle East is having what? Oh, that was last week's news. Everyone buy the dip. That's what seems to be the attitude on the street, right? Oh, Greece fell apart, buy the dip. Spain fell apart, buy the dip. Now we got Egypt fell apart, buy the dip. You know what I mean? It doesn't stop. I don't think it's going to stop. I think with $4 trillion backing this market, it doesn't stop for a while. It beats the crap out of a $40 billion bet, $50 billion somewhere in between in the crude. So for now, we trade charts only. I spoke some fundamentals to you, which are meaningless to me because the 11-day cycle I showed you on the chart and those bullish indicators are the only thing that matters to me. I don't care about the crude. I don't care about the news. I don't care about my own opinion, and I don't care about yours. I only read the graphs. I am a technical analyst. I take a flag. If it's a bull flag, I'm bullish. If it's a bear flag, I'm bearish, and that is the way we handle things. If we see a head and shoulders, we trade them that way. If we see averages crossing, we trade them. What we do not do is we do not try to anticipate the news, because the news is fundamentals, and fundamentals always come out in the charts first. So put your stop in, believe in the 11-day cycle, believe in the transportation average, our leader, and do not fall in love with the downside. We've seen a couple of downside days. Relax. Don't fall in love with that attitude of market moving lower. I don't think that's where this ends up. As you know, I think year end we end up as high as 1650. For now, we'll have to deal with little pullbacks, but I think this crude thing begins to blow over, or at least people using their magnifying glasses and telescopes and microscopes to stare at the Middle East and the crude problem. I think that starts to wane a little bit. And if the attitude changes, our stock market explodes. So, traders, be ready. Hopefully, crude will come down a little bit, and that would really give us the gusto that we need. But remember, again, a stop is your best friend, because if crude explodes, there's no way our stock market goes up on that day that crude goes higher. All right, traders, there's my argument. Do your own homework, pull your own charts, come meet me at my site, www.livewithoscar.com, and jump into my free trading rooms. I will be there to help you become a better analyst. Last but not least, remember to be there listen, right? This is a telephone interview, isn't it? From what I understand, tomorrow CNBC is a telephone interview, but I think I get a full half an hour if we have this right. Bloomberg. The schedule was a little bit, it's Bloomberg? Did I say CNBC?
You did.
Fox, it's going to be on Fox, I promise you. Anyway, be there. I'll see you later. Traders, don't forget, keep your emotions out of trading. One of the best things you can do to help yourselves with that is say this to yourselves every morning, every afternoon, every evening. And you know what that is. Stops are in. Emotions are out. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.